Hello class, welcome to chapter 1, a new overview of securities, market and trading. In this chapter, I will summarize some important points of the investment environment, asset classes and financial instruments, and how securities are traded. For the first topic, the investment environment, you need to remember some important points. First, real assets create wealth. Financial assets represent claims to pass or own of that wealth. Financial assets determine how the ownership of real assets is distributed among investors. Financial assets can be categorized as fixed income, equity, or derivative instruments. Top-down portfolio construction techniques start with the asset allocation decision, the allocation of funds across broad asset classes, and then progress to more specific security selection decisions. Competition in financial markets leads to a risk-return trade-off in which securities that offer higher expected rates of return also impose greater risk on investors. The percent of risk, however, implies that actual returns can differ considerably from expected returns at the beginning of the investment period. Competition among security analysts also removes financial markets that are nearly informationally efficient, meaning that prices reflect all available information concerning the value of the security. Passive investment strategies may make sense in nearly efficient markets. Financial intermediaries pool investor funds and invest them. Their services are in demand because small investors cannot efficiently gather information, diversify, and monitor portfolios. The financial intermediary sells its own securities to the small investors. The intermediary invests the fund thus raised, uses the proceeds to pay back the small investors and profits from the difference or the spread. Investment banking brings efficiency to corporate fundraising. Investment bankers develop expertise in pricing new issues and in marketing them to investors. By the end of 2008, all the major standalone U.S. investment banks have been absorbed into commercial banks or have reorganized themselves into bank holding companies. In Europe, where universal banking had never been prohibited, large banks have long maintained both commercial bank and investment bank divisions. The financial crisis of 2008 demonstrated the importance of systematic risk. Systematic risk can be limited by transparency that allows traders and investors to assess the risk of their counterparties, capital requirements to prevent trading participants from being brought down by potential losses, frequent settlement of gains or losses to prevent losses from accumulating beyond an institution's ability to bear them, incentives to discourage excessive risk taking, and accurate and unbiased analysis by those charged with evaluating security risk. Next, some important point of asset classes and financial instruments you need to remember. Money market securities are very short-term debt obligations. They are usually highly marketable and have relatively low credit risk. Their low maturities and low credit risk ensure minimal capital gains or loss. These securities trade in large denominations, but they may be purchased indirectly through money market mutual funds. Much of U.S. government borrowing is in the form of treasury bonds and notes. These are coupon-paying bonds usually issued at or near par value. Treasury notes and bonds are similar in design to coupon payment corporate bonds. Municipal bonds are distinguished largely by their tax-exempt status. Interest payments but not capital gains on these securities are exempt from federal income taxes. The equivalent taxable yield offered by municipal bond equals the yield of municipal bond divided by 1 minus tax. Market pass-through securities are a pool of markets shown in one package. Owners of pass-throughs receive the principal and interest payments made by the borrowers. The originator that issued the mortgage merely services it and passes through the payment to the purchasers or the pool. A federal agency may guarantee the payment of interest and principal on mortgage pooled into its pass-through securities, but these guarantees are absent in private label pass-throughs. Common stock is an ownership share in a corporation. Each share entitled its owner to one vote on matters of corporate governance and to prorated share of the dividends paid to shareholders. Stock equivalent equity owners are the residual claimants on the income earned by the firm. Preferred stock usually pays fixed dividend for the life of the firm. It is a perpetuity. A firm's failure to pay the dividend dues on preferred stock, however, does not precipitate corporate bankruptcy. Instead, unpaid dividends simply accumulate. Variants of preferred stock include convertible and adjustable rate issues. Many stock market indexes measure the performance of the overall market. The Dow Jones Average, the oldest and best known indicators, are price-weighted indexes. Today, many broad-based market value-weighted indexes are computed daily. These include the Standard Poor's 500 Stock Index, the Nasdaq Index, the Washies 5000 Index, and indexes of many non-U.S. stock markets. A call option is the right to purchase an asset at a stipulated exercise price or on or before an expiration date. A put option is the right to sell an asset at some exercise price. Calls increase in value while put decrease in value as the price of the underlying asset increases. A future contract is an obligation to buy or sell an asset at the stipulated future price on a maturity date. The long position would commit to purchasing gains if the asset value increases, while the short position would commit to delivering losses. For how securities are traded, there's some point you need to remember. Firms issue security to raise the capital necessary to finance their investments. Investment bankers market these securities to the public on the primary market. Investment bankers generally act as underwriters who purchase the securities from the firm and resell them to the public at a markup. Before the securities may be sold to the public, the firm must publish an SEC-approved prospectus that provides information on the firm's prospects. Already issued securities are traded on the secondary market, that is on organized stock market, on the over-the-counter market, and occasionally for very large trades through direct negotiation. Brokerage firms with access to exchange sell their service to individuals, charging commissions for executing trades on their behalf. Trading may take place in dealer market via electronic communication networks or in specially designated markets. In dealer markets, security dealers post bid and ask prices at which they are willing to trade. Brokers execute trades for their clients at the best available prices. In electronic markets, the existing book of limit orders provides the terms at which trades can be executed. Mutually agreeable offers to buy or sell securities are automatically clocked by the computer system operating the market. That was traditionally a dealer market in which a network of dealers negotiated directly over sales of securities. The next was traditionally a specialist market. Today, however, trading in both markets is overwhelming electronic. Buying on margins means borrowing money from a broker to buy more securities than can be purchased with one's own money alone. By buying securities on margin, an investor magnifies both upside potential and downside risk. If the equity in the margin accounts fall below the required maintenance level, the investor will get a margin call from the broker. Short selling is in the practice of selling securities that the seller does not own. The short seller borrows the securities from a broker, sells them, and may be required to cover the short position at any time on demand. The cash proceeds of a short sales are kept in escrow by the broker, and the broker usually requires that the short seller deposit additional cash or security to serve as margin, like the collateral. Securities trading is regulated by the Securities and Exchange Commissions, by other government agencies, and through self-regulation of the exchanges. Many of the important regulations have to do with full disclosure of relevant information concerning the securities in question. Insider trading rules also prohibit traders from attempting to profit from inside information. Thank you for listening. See you in the next lecture.